Hey everyone, and welcome back to another portfolio update for you today. So, the couch investing portfolio was up 1.59% over the past week, while the S&P was down 0.28%. Year to date, as you can see, we're still up 21.53%, whereas the market is up 6.41%. And since the start of the portfolio, we are up 94%, whereas the S&P 500 is up 25.54%. So we're going to go over a couple of moves that I've been making over the past couple of days. The Tesla weekly insured numbers out of China, the upcoming earnings week, because yes, there are some very big companies reporting over the next couple of days, some macro data, Bitcoin related data as well, and then some very interesting news with regards to, well, whether it's Tesla, AI, maybe Oscar Health as well. So all of that in this video. All right, so first up, quick overview of the portfolio. I do want to show you two videos also from SoFi CEO and one video, a small snippet from Oscar's CEO as well. And this will explain why I become a bit more bullish on that name. So right now, SoFi, as you can see, we closed out the week at $21.20. So yeah, it stays the number one position here by far. Google is actually now taking the number two spot over of PayPal because PayPal went back down, whereas Google finally is making its way back above $180. Rocket Lab here at number 4, insane performance from that stock. And here, as I said previously, it would not surprise me if the stock does pull back a little bit. And to be honest, I will invite a big pullback in order for me to increase that position even further. Micron still doing well. Then we've got here Uber at $95. I do think that it reached all-time highs over the last couple of days. AMD still above $140. Great performance there. Then we've got Intel. Slowly but surely, I am getting back into the green for Intel. Still down 5% on that position. Of course, it is quite a big year for Intel, for Libutan. We are, of course, going to get, well, a lot more information. I believe they report July 23rd or 24th or so, so pretty soon. Nebius here did come down a little bit more on a Friday, and this is a stock where I did already increase it by 8%. If we go even lower, as I said here, if we go even lower towards the $40 or so, I will be increasing that position a bit more because I do want Nebius to become a bigger chunk of the overall portfolio. Alibaba, yes, it is back at $106. I'm still up on that position, but as you can see, I am buying more shares, increased that position also by 8.33% and got paid, right? Fake money, you say, but no, I got paid $126 in dividends from Alibaba. Then another, in my opinion, very, very undervalued name here, and that's the local, and that's also a position where I've added 7.76%, well, increased that position by 7.76%. The reason why I'm not adding more aggressively right now is because we are entering the earnings season, and so I do want to keep a little bit more cash entering that earnings season in case we do get some big opportunities. Meta is basically a nice little anchor for this portfolio, performing quite well. Then we've got here Upcelera, now in the green, up 3.6%. United Health, I did increase it by a tiny bit. And then you've got here Oscar. By the way, Oscar and United Health, as you can see, very, very small positions right now in my portfolio. But as I've explained previously, with United Health, of course, I am now, and same with Oscar actually, as I think the thumbnail will say that, I am now in this invest and then investigate type of move here with those two names. It's something that Stanley Druckenmiller has said, invest and then investigate. And this is what I'm doing with these two names. I have time to build up my position here. United Health, they will report their next quarterly figures July 29th. So I do expect quite a big move from the stock because we're going to get a lot more information from management. And yes, this is a play for me, although it's just 1.5%, it is $4,000. So if that $4,000 can increase by 50% or so in the back half of this year, for me, I think it's still quite good money, right? In 6 months for this, $2,000 in gains, I think that's quite good. As for Oscar, since Oscar market cap wise, of course, here I'm already down 17% on that position, but it is still very small, so I don't really care. It just gives me more time to study the business and all of that. With Oscar, of course, it being a much smaller company, and I'll explain a little bit more afterwards, it also gives me it pushes me to hold this one for much longer because of the potential multi-bagger. And I do think that there is here a potential multi-bagger. Not because I understand the industry 100%. No, and I admit it. That's why it is so small at the moment, and that's why it will never be as big as a Google or PayPal for my portfolio. But here as well, if this position can be worth a couple of thousands of dollars, right? Even if, let's say, it is $5,000 and this become a 3x, 5x, still a significant amount of money, I think, for most of us, right? Okay, it's not millions or hundreds of thousands of dollars. It can grow into that if I keep adding and when I understand it more and more. But for me, the most important part, especially with these types of companies and these types of investments, is to trust management. And I'll show you a little clip here. This is a 1 minute and 30-second clip from an interview the CEO had, or an interview or podcast he had a month ago. So the information here is quite fresh. I link the whole podcast in the description and in the pinned comment.
Where is the business now on this journey to go? The stock price is higher. I think I saw it around 16. It probably fluctuates, but $16 a share. You got a market cap of about $4 billion. How far along are you on your journey now?
We're through in 2025. Our objective is to have so we made money in 24 for the first time. We made adjusted EBITDA in 23, which is what we told the street. But in 24, we actually made EBIT. We made real money you can count, right? Instead of funny money. And so that kicked it off. This next year, we've promised 2.5% margins to the street in our earnings through the year, and growth of up to 11 billion in premium. And why those two numbers matter is that 11 billion at 2.5% margins in the insurance industry generates a $5.5 billion market cap. We're at 4 point something right now, 4 point low, right? So that's one piece. At 5% margins, you get a 1x of revenue. And so by 27, what we committed to the street is we're going to have 5% margins, real margins, not EBITDA, EBIT, and we're going to have 14 billion in revenue. That makes the stock price of the company somewhere between $45 and $55 a share, depending on the PE multiple from where we are today.
Now, of course, you might say, yeah, but that's his job to say that, etc., etc. Well, if you will listen to the whole interview, you will understand already who Mark is, who that CEO is. And I'll show you what he did before he joined Oscar. So, as you can see, before he joined Oscar, he was 15 years at Aetna and 4 years at Cigna. Okay? This is someone that knows this industry very, very well, that has spent many, many years in the industry, that has quite a lot of connections. And he said it before he took the job at Oscar. He said it like this, and you will hear it during the interview. He said, are you looking to flip this business? Meaning basically turn it around because it was at $2-3 or so. You want to flip it, or you truly want to change the industry? That's the type of CEO that we've got here. This is not the type of CEO that comes into Oscar and then they're worth $5-10 billion of dollars. They'll sell it and move on. No, he truly thinks that he can turn this thing around and make it a huge company that does change the whole industry. And when you invest in these types of companies in that industry, I think it's very, very important to know who the CEO and the leader is of that company. And so coming back to the last couple of parts here, look, I know this is very small and you might think, oh, this doesn't make any sense. Well, it does make sense to me because, again, I am in the invest and investigate part of this whole thing. I am planning to deploy more and more cash over time in these positions. Like I said, I still have time. Yes, I did already increase those positions, right? I did increase United by 30% and Oscar by 38%. Of course, the price of the stock, especially for Oscar, is down even more. But okay, fine. This means that the next time I can add, if it doesn't move, I can acquire more and more shares. I'm very, very comfortable with what I own. Some might say, oh, but you own way too many companies. Disregard the last two, NVIDIA and Palantir. Those are just 3 shares. The others here, of course, you can clearly see concentration-wise, it's all in the top 5, top 6, right? That's the concentrated part of the portfolio. And the others, yes, are companies that I like, are companies that I think are undervalued, and are companies that I think that will contribute to the performance of this portfolio, which I think has performed quite well. Moving on to Tesla real quick. The numbers out of China for last week were 5,010. Of course, start of a new quarter, you can clearly see, usually we start off quite low export-wise. This is the focus. And this, of course, does take, I think, June 30 into play here. So we're starting off the quarter like this. You might have noticed, or you might not have noticed, but if you go on Tesla's website, you will see that there is a new feature, in-car AI, and of course that's the integration with Grok. So for those that did wait for this, I believe this is becoming available right now. Another interesting thing, and this is something we've talked about for a long time, and by the way, for those that are new here, if you are surprised that Tesla is not in the portfolio anymore, it's because I made a decision that I do not need the extra exposure to Tesla, despite it being up over 60% for me. In the public portfolio, it still is in my core portfolio where I have just, well, I think now 6 positions, which are Amazon, Meta, Mercado Libre, Tesla, Google, and yes, even more PayPal there. So India, Tesla is going to enter the Indian market. The Indian market, of course, is a big market, but it's a market where you will need affordable models. Plain and simple. Now, what was also interesting, and this is with regards to the United States, the top 10 best-selling EVs in the United States in the first half of 2025, units sold here. Look at number 1 and number 2. Comes as a surprise, right? Model Y and Tesla Model 3 taking here the number 1 and number 2 spot. Number 10 goes to Tesla Cybertruck. So yeah, when we look at best-selling EVs only in the United States, Tesla here still number 1 and number 2 quite comfortably. Moving on to the upcoming weeks, and yes, it's the start of a new earnings season. Pretty crazy. I know I was as surprised as you. So we first start off with some banks, right? We've got the banks here on Tuesday, which will probably give us more information about what they're seeing with consumer sentiment, spending, rates, and all of that. So that's on Tuesday. On Wednesday, we've got ASML before the market opens and some other banks here as well. But for all of us, of course, we are much more interested in ASML. And then on Thursday, before the market opens, we have TSMC. Now, since we are going live every single day almost at 8 a.m. here on this channel with Jose, we are, of course, going to cover ASML and TSMC. And then Thursday, after the market closes, we've got Netflix. To me, ASML and TSMC will, of course, give us already a pretty good introduction to what we should be expecting from not only the other semiconductor players, but also some of the big tech players as well. So that's going to be quite interesting to hear, maybe CapEx plans as well. And then for Netflix, to be honest, Netflix becomes a very good but boring compounder, right? I don't think they will miss. I think those will be another very good quarter for the company. Moving on to some market data. So here we see the S&P 500, the number of days that it was above to the 20-day moving average sits at 52. And it didn't really happen that many times before. So are we due to a pullback? Remains to be seen. I've shown you plenty of data points over the last couple of weeks, and it does seem like we can continue to go back up. I mean, if we look at Bitcoin, for example, Bitcoin rockets past 118,000, leads to over $1 billion shorts getting liquidated. I mean, we do love the smell of shorts being liquidated in the morning. And of course, the higher the price of Bitcoin, the better it will be for Bitcoin miners, more specifically here, Iron. Now, this is also something I do want to touch on. You might not have seen Applied Digital in the public portfolio, nor can you see Iron or Cypher, because I do not want to put those YOLO bets and jeopardize the return of that portfolio. Okay, those are very small bets that I do with casino money basically, and that's in another portfolio, just so it doesn't disrupt. Even if it works out, which I hope it will, I do not want it to be in the track record of that portfolio. But I do hold a very small position in Iron, Cypher, and Applied Digital. So here, Iron, for example, they did show us a couple of examples, well, scenarios. So this is the annualized illustrative adjusted EBITDA sensitivities, and it shows us what happens when the price of Bitcoin is at 95,000, 125,000 higher or lower. Mining revenue, net electricity costs, overheads, renewable energy certificates, AI cloud services contribution, and then you get here the adjusted EBITDA. So the last time they talked about this, they showed us the Bitcoin price at 95,000. Well, now we are already, close to $20,000 higher, which of course is good for them. Now, they have expanded already to 50 exahashes, and that's capped at that. All the focus is going to be on expanding the AI side, the HPC side of the business. But in the meantime, a higher price of Bitcoin for a very profitable business that is here, their Bitcoin mining business, is going to be very, very good in order for them to finance the other side of the business. Moving on to some more data here, this is what has happened after we've had a 3-month rally of over 25% for the S&P 500. As you can see, things are looking still, like I said before, things are looking quite good for us. But again, as I've shown you back in April, for example, where things did not look very good, right? When I've shown you that, 100% of the time in the past, the next day or the next week, the market was green. Well, in our scenario, the markets were red again because of the whole tariff situation, which again could be the same thing here, right? We could still have that tariff uncertainty. I believe letters have gone out to Europe and maybe Mexico as well. So there still is that uncertainty, plus we enter the earnings season. So yes, the data, of course, here is on our side, but just because it happened before does not mean that it will happen again. Just keep that in mind. Now, keeping that in mind, here, as you can see, the data also suggests that buying at all-time highs actually makes sense. Yes, I'll repeat it again so you don't think that you heard something wrong. Buying at all-time highs actually is a good idea, right? This is basically what it shows you here on the left and on the right, right? Invest on any day, that's the gray bar right here. Invest on a new high, you get an average cumulative S&P 500 total returns that is higher. Yeah, believe it or not, I was also shocked here. Last couple of things here, and this is XAI related, Grok related. By the way, according to a report, SpaceX is going to invest $2 billion into XAI. XAI is trying to raise, I believe, $5 billion in the latest funding round, and SpaceX is going to invest $2 billion. Some people have already said, why isn't Tesla participating here? Well, in my opinion, Tesla should have participated already a year and a half ago when XAI's valuation was much, much lower. If you ask me, even if it goes to a vote, Tesla buying in at $200 billion valuation, maybe I might say yes just for the sake of it, but I don't really like that move, right? We should have gotten access to XAI when it was worth $10 billion, $20 billion or whatever. But okay, it is what it is. By the way, I do have an allocation for SpaceX. If you're interested in that, you do need $500,000 because that's the minimum investment. So if you're interested in that, maybe email me or send me a DM on X. Now, what's interesting here is that Grok, right? Grok, which is from XAI, which by the way is something that didn't exist, 2 years ago, 3 years ago, is now, according to a third party, right? Not according to XAI, but according to a third party, is now the number one model here based on the 7 evaluation that artificial analysis has made. So pretty impressive. Congratulations to the whole team, because again, remember, this is a company that did not exist, I think 2.5 years ago. So to come here and be now the number one model, in front of OpenAI and in front of Google, of course, both of these players will probably already release their upcoming model, which might also be this one, because these things move quite rapidly. But at the end of the day, this is very impressive. So congratulations to the Grok and XAI team. Lastly, I do want to go over this SoFi interview. So this was SoFi CEO live in Sun Valley on CNBC.
Good morning to you. And that's right. I'm joined now by CEO of SoFi, Anthony Noto. Anthony, thanks so much for joining us here today in Sun Valley. Your stock has been absolutely on a tear and got a pop from the news that you're expanding to private markets investing. Stock was up 7% on this. How big of an opportunity is this for SoFi?
We think it's a large opportunity. It's part of our overall strategy to be a one-stop shop for all your financial services needs. Investing is one of those areas, and we're giving access to Main Street investors to products they would not otherwise get in prior history. So we started with single stocks, launched fractional shares, added ETFs, robo accounts. We then started doing IPOs. We were the exclusive retail provider of the Rivian IPO, as an example. And then about a year ago, we launched alternative assets, including private equity, private credit, private real estate, and then even an opportunity to invest in some private companies, specifically through SPVs like Anthropic as well as SpaceX. And this is an evolution of now being able to invest in private companies through funds. And you can invest with as little as $10. The minimums are all different, but on one of them it's $10, one is about $500, and one is about $2,500.
But another...
And this is very important to note, by the way, when you sign up to these things and you invest, to just read the fine print, right? Read the fine print, read the cost associated to all of this, because I do believe that right now, especially in this gamification of investing or maybe tokenization of investing, right? Shout out to Robinhood, because they do revolutionize a lot of the retail investing part and participation part of all of it. It's always important to read the fine print so you do not get screwed over.
Excuse me. What's seen as another potential tailwind for SoFi is the idea that the new Trump bill could cap federal borrowing for college and grad school, which could drive more business to SoFi. What are you expecting in terms of growth because of that?
There will be a large opportunity for us to continue to leverage student loans, and the new bill will provide a bigger opportunity for us. But it's a much smaller piece of our business now. More than 50% of our business is from non-lending revenue streams. We've really kind of de-risked the balance sheet and tried to become more capital light. We've had 13 consecutive quarters of greater than the rule of 40, which is your revenue growth plus your EBITDA margin. And someone pointed that out to me. And our guidance for the second quarter will actually be the 14th consecutive quarter if we achieve it. And we have great momentum in the business. So while we're excited about the student loan opportunity, it's small relative to everything else that we're doing. That's driving the growth of our business and the rule of 40 success.
You do have a lot.
He said here, if we do achieve it, I think he knows very well that he has already achieved it. And so, in my opinion, I think we are already expecting here a nice little beat for the upcoming quarter. And he's correct, right? The lending business, although it is an important part of the business, it has not been the largest part of the business or as important as it was 4 years ago, for example. But it is a part of the business that more recently has started to accelerate, and contribution profit, of course, has become better and better here. So very important. And then when it talks about the becoming a high margin business, fee-based business, lower risk type of business, that's of course coming from that loan platform business, which is under the financial services one, which of course is growing very, very quickly.
A lot of customers, though, in this younger demographic, and this younger demographic is being impacted by a couple of factors. We've seen unemployment for recent college grads higher than the overall unemployment rate, and we're also seeing a lot of concern about AI taking jobs, not just now, but increasingly in the future. How are you seeing this demographic react to those issues, and how is it impacting your business?
We do go after a younger demographic. We're going after people that have been successful, they're overachievers, but they're not well served by the financial markets, and we want to be there for every one of their major decisions in their financial life, like paying for college or buying a home and all the days in between. And our business is very strong. We came into the year with great momentum. In Q1, we had over 30% revenue growth. It was an acceleration. We've been able to maintain more than 30% member and product growth, and we don't see that slowing down. So we're seeing real strength across the consumer and spending, improving credit, and the desire to do more with us.
But when you look at the evolution of this younger consumer, the new CNBC generation Innovation Lab poll shows that young people are so worried about AI taking their jobs. How do you expect that consumer to change in terms of the services that they get from SoFi?
What I'd say is every innovation drives more opportunities. Yes, some of the opportunity is closed, but it'll create new opportunities. And I believe our country, with the strongest economy, the strongest level of innovation, the strongest military, the strongest currency, will continue to drive opportunities for American people. And the innovation will just cause those opportunities to change. You can't really predict what they will become, but without a doubt, if you look at every cycle in history, when you've had these big super cycles from technology, it's created more opportunities, not less. And I think that will be the case here.
First of all, I don't know where Sun Valley is, but that place is gorgeous. Incredible. Second of all, look at how comfortable and how confident Anthony Noto here is. This isn't someone that is here to play some games and, oh, our stock is up, yeah, at a 3-year high right now, etc., etc. No, this is someone that is willing to take this company to higher heights. He has set his goals, right? Top 10 financial institution in the United States. I mean, maybe it's time to believe what he's saying, right? Maybe it's time for Wall Street to actually adjust the estimations and the expectations and the estimates around SoFi. I think it's time, right?
Deploying AI across your suite of products.
We're using it in every area. So customer service, automating dispute resolutions, filing suspicious activity reports, but also personalization. We're testing a product right now called Cash App, or Cash Coach, which allows you to look at your cash across all your different partners, and we can help you optimize what to do with that cash. First of all, we'll show you how much cash you actually have and how little you're earning on it and ways to actually optimize it, drive a better return. Our goal is to help you spend less than you make and invest the rest. And that's what you need to reach your American dream.
I mean, other than that little slip here, Cash Coach and Cash App, I think this was a wonderful, wonderful interview. So all in all, to summarize, and for those that will ask me about Zeta, for example, yes, I do still think that Zeta is very cheap. You know why? Because the stock basically hasn't really moved that much and the company is still doing what it should be doing. So yeah, my opinion around that hasn't changed. Could it also be one of those short-term moves that I could be making? Definitely, definitely. But like I said, right now I am focused on those two names right here. Yes, it is in the same industry. Yes, there is a lot of uncertainty as well. But the more and more I learn about those specific companies and management, the more comfortable I will feel about it. So all in all, that's about it for me in this video. I hope you enjoyed this. Like, subscribe, and I see you all in the next one. Bye-bye.